Today, folks, we're diving into 5 Canadian dividend stock powerhouses that you need to be paying attention to right now. And then at the end of this video, we're taking a look at 2 monthly paying Canadian dividend ETFs that encapsulate all the wonderful stocks we're talking about today. So if you are on a path to financial independence, if you love Canadian dividend stocks, go smack that subscribe button. Join me on that journey and like this video while you're at it as we get into the very first stock that everybody has been loving recently, which is Canadian Natural Resources, CNQ, baby, with a whopping 4% starting yield today. It's only up 14% year to date, but over 5 years has doubled your money, outpacing the broader markets by leaps and bounds with an insane 78% institutional ownership, one of the most institutionally owned companies in Canada with a very low 56.9% payout ratio. It is no surprise this company has ballooned the dividend by 12 cents roughly, or 11 cents a decade ago, to today where we're at 53 cents, almost 5xing the dividend, doubling up your friggin' stock price just in the last 5 years. Like, does it get any better than this? Yes, because the company just announced a 7% increase in its quarterly dividend, the 25th consecutive year of dividend growth with a compound growth rate of 21%. This financial decision follows the company's recent acquisition of Chevron Canada's Alberta assets and is supported by Canada's Canada Natural's robust free cash flow and strong financial standing, which means the company is acquiring more assets that will hopefully lead to further cash flow and continuing to excel these beautiful returns for us Canadians out there. But if we take a look, the revenue growth isn't that excelled, probably on the back of weaker oil prices. But what the company has done exceptionally well is buying back shares at a pretty aggressive level. Like, they really have been accumulating a lot of shares, leading to higher earnings per share growth, which has probably been helping excel the stock price. Now, when it comes to the dividend yield itself, it's actually paying out a historically high yield for, where it sits. Because if we went back a decade ago, the yield on this company was only like 1 or 2%. Today, the dividend's sitting at about 4.5%, and with the dividend growth you're getting at 20%, it's just insane. So congrats to anybody that's been able to ride this through and absolutely crush it. And this is a company that is incredibly diversified: 27% natural gas, 28% heavy oil, light oil and NGLs at 10%, and then SSCO at 35%. But if you dive into this company basically has the largest crude oil reserves and the largest natural gas reserves in Canada. It is literally one of the leading companies globally when it comes to the powerhouse of energy, making it, the top one that I wanted to talk about today as we get into numero dos. Number 2, Manulife Financial Corp. We're talking about the insurer players out there, and this company, whoo, baby, up 40.88%. A company that for the last 5 years didn't really do a whole lot for investors. It did flatline only up to the recent rally. This has a lot to do with new customer acquisition, the interest rate sensitive markets, because these companies have a lot of cash. They tended to do better in higher interest rate markets with a starting yield of 3.91%. This company is also, 59% held by institutions, not as high, but anything over 50 is beautiful. It offers more stability to the stock price with a 65% payout ratio. This company's taken the dividend from 13 cents a decade ago to 40 cents today, over 3xing that yield, making it the second one on our list that has a lot more volatility in its revenue. Insurance companies have very unstable revenue, and this company as well, though, when we take a look at the shares outstanding, has very aggressively this year been buying its shares back, which is an appropriate thing, I think, to do, which is really helping that bottom line earnings per share. If we take a look at the yield today, the yield is starting to fall off a bit from the historical highs that we've experienced through 2022, but it's still over its history a lot higher than where it has been in that 3% range. If we take a look at what's been driving this, it has a lot to do with basically new business value. In the reported quarter was $528 million, which was up 21.4% from a year ago. Keep in mind that's US Canadian. It was $723 million. New business, basically contractual service margin increased to $459 million, or again 628 million CAD, which rose 4.1%. APE sales, which are basically annualized premium equivalent, was up 16.7%. These are all the things that have been driving this insurer player. If you don't understand insurer players out there, don't worry. I'm in the same boat. I am not that privy to understanding everything about these companies, but what I do understand is looking at that core earnings per share, the return on investments, and watching the growth unfold in front of our eyes. AP, like again, here's the APE sales. When you take a look at basically new business, the CSM, all these are growing at very nice rates, which has everything to do with why the company's excelled and made it to the top second of my Canadian dividend powerhouse list, taking us to number 3, which is a largely controversial one, surprisingly, which is Enbridge. This is the largest liquid pipeline company in North America. It is basically the blood of North America when it comes to energy, and it kind of falls in line with C&Q, but a much higher starting yield at 6.57%. Over the last 5 years, hasn't offered a huge amount of return, but anytime you've bought the dip, if you're looking for capital gains, you've done exceptionally well on this company. And this company has a huge payout ratio that gets largely misunderstood, primarily to the fact that the company has major depreciation and amortization costs and its massive infrastructure pipelines. So again, keep that in mind when you're running the math on the current cash flows. Held by institutions, again, 54%, offering a bit more stability as the company is taking its dividend from 35 cents up to a whopping 92 cents. Again, almost 3xing the dividend, making this one of Canada's biggest dividend powerhouses out there. And the current yield is at the historical highs for the company, which is absolutely incredible for people looking for really juicy starting yield. As revenue starts to follow the oil prices a little bit more in tandem here. Again, the C&Q and Bridge here not really excelling in revenue growth, but still very stable to watch over long periods of time. If we take a look, this company is slowing down a bit from the dividend growth we've seen in the past. I think C&Q takes the cake on this one because the dividend growth is only expected to grow 3%. Through this year, we'll see how the company actually unfolds because it typically does a bit better and has been doing a lot of acquisitions. Actually, if we take a look at the recent share repurchase, this is another thing I do not like is they've been issuing more shares because they've been buying more natural gas providers, I think, in the United States. We've talked about those sales that are hopefully going to lead to further dividend growth in the future. And you guys can take a look. I mean, again, these literal pipelines go all the way from Vancouver and Alberta all the way down to Texas. Everything from natural gas. If you go look at if you're a natural gas user, go look at the pipes outside. It's very likely there's an Enbridge logo on them. So love Enbridge, love Manulife, love Canadian Natural Resources. Leading us into the more financial side of things with the banking sector, it could not be a Canadian dividend video without talking about the Canadian banks like Pokemon cards, baby. You got to be collecting them all. I love all the Canadian banks, but there are some exceptions to who are the better performers, leading us into National Bank. This one's up 27% year to date with a starting yield today of 3.44%. 5 years have pretty much doubled your money, making it, again, a Canadian powerhouse stock. If we take a look at the institutional ownership, currently sitting only at 34%, is not widely received as much as these other Canadian powerhouses, but with a payout ratio of 41.29%, you better believe this company has room to increase that dividend. And oh, baby, over the last decade, have they ever, from 46 cents to $1.10, over doubling of the dividend. Again, not as excelled as these other stocks, but when you look at the total return performance, it has definitely kept pace and has been one of the best performing Canadian stocks out there. Again, I don't want to throw shade to the other Canadian banks. National Bank has been a smaller company that has had more room to grow, but we've seen great performance out of many of the banks coming into 2024 after the wicked crash of many. But we'll come back to the banks in a moment. I also want to shout out Dollarama as the fifth powerhouse in Canada that is absolutely crushed. Yes, the starting yield is not attractive at all, but when you, again, accumulate total return over the last 5 years, right up there with Canadian Natural Resources, up almost 200%. If you take a look, this one is only 44% held by institutions with an 8.4% payout ratio, meaning this company has plenty of room to grow that dividend, which they have from 2 cents to 9 cents. Again, pretty excelled performance on that aspect, and we can see it in their sales, proving to be one of the most recession-proof businesses, one of the most interest rate non-sensitive stocks out there. They do have a lot of debt, keep that in mind, but when we get this kind of growth, it's no surprise that they're able to keep up with it. Sitting at $707 million for the last quarter from $638 million. Net earnings here, $285 million versus $245. If we just take a look at the 26-week period, $501 million versus $425 million. The growth here is absolutely accelerated, which makes it one of the more intriguing stocks to be looking at for sure. And I just wanted to kind of shout this one out because Dollarama, we all know, we've all been to probably a lot. When I go to the movies, I always go pack my pockets with cheap snacks from the dollar store. It's becoming a Canadian staple at this point in this inflationary market, though. Nothing at the dollar store is really $1 anymore, is it? But still, what a crazy performance we've seen out of this company, and one to keep an eye on for sure. And I really want to round the conversation down to, if you're not buying these individually, which is something you have to have the stomach for, I always recommend looking at two Canadian ETFs, both of which I have a great admiration for. In both, I've been highly considering adding to my portfolio as I've been recently really loading up on VDY. But one that we mentioned on the live stream last night was XDIV. That is the ticker for the BlackRock iShares Core MSCI Canadian Quality Dividend Index ETF. Both these pay monthly and both have had absolutely exceptional performance. If we take a look at the return on this from 10 years ago, or basically since if we go all, we can see this actually only goes back. So it's a relatively new ETF because the history is only till 2017. So we don't have a full 10 years of performance. But if you invested $10,000 in 2017, you are now sitting over $20,000 in total returns between growth and dividends, which is absolutely wonderful. And as mentioned, if we scroll down, the yield starting today is 4.29%. And if we take a little bit deeper into the actual fees, they're some of the lowest in the industry at 0.1%. So very beautiful stuff to see with a very diverse holding in these incredible stocks from Manulife to Sun Life, Royal Bank, Toronto Dominion's in here, Enbridge, Pembina Pipeline, Suncor Energy, Fortis, Power Corporation of Canada, Magna International. If we take a look at all the holdings and we go a little bit deeper down, because again, these are pretty well equally weighted. I mean, we're talking about 9% down to 6% just in the top 10, making up most of the portfolio. But if you go a little deeper, you will see you get some TELUS in here, some Emera, Canadian Tires in here. So you do get a little bit more. Canadian Utilities is in here. Again, more smaller percentage, upper weighting the more Canadian dividend powerhouses. But on the other spectrum as well, if you want other performance, other exposure that's more passively weighted by market cap, similar to the S&P, I always recommend taking a look at VDY, which today is paying about 4.3%. Again, starting management fees at about 0.2. So it's about double the fee that you're going to pay with BlackRock's dividend ETF. But if we take a look here, you're going to be getting a little bit different weightings, right? You're going to be upper weighted Royal Bank because it's a passively weighted ETF based off market cap values. Toronto Dominion in second, Enbridge basically weighting the upper companies in Canada at the top. Canadian Natural Resources in here, Bank of Nova Scotia. So both of these offer incredible performance and dividend growth. And I really think this is some of the best way to get exposure to Canadian stocks. If we do take a look at the 10-year, well, let's just go since inception. This ETF has been around a little bit longer, so it's going to be about just over 10 years worth of history going back to 2012. But if you invested $10,000 today, your investment would be worth over $30,000. But again, keep in mind, this ETF has a bit more longer performance behind it than the BlackRock has. So either way, XDIV, VDY, I think you can cost average into either of these ETFs or both these ETFs and get some of the best exposure to the Canadian powerhouse dividend stocks. But I would love to know what you consider the best Canadian dividend stocks out there so I can make a video on them in the future.